Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and of course, we've got these great topics for you today. Restricted stock units, a refresher, housing affordability. We're also going to get into converting savings bonds into electronic bonds, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Oh, braving the heat. The heat finally came to the Central Valley. Yep, topping up over 100. So summer's here for sure.
Yes, sir. I've checked my parents. They're in Northern California, almost Oregon border, and it was like 9 p.m., 92 degrees at night. I'm like, oh goodness, okay, it is here.
Yep. It's an adjustment. That's for sure.
Yes, sir. Well, hey, let's dive right in. Restricted stock units. We're doing a refresher on this. Restricted stock units, also known as RSUs. Let's give a bit of a refresher on exactly what RSUs are and kind of get that out there so people understand as we move forward through the conversation about it.
Yeah, obviously, this is a topic that doesn't affect everyone, but still, it's become more and more common that companies use restricted stock as a way to compensate employees, right? And have some of their compensation tied to the stock price, where the value of those units is going to increase or decrease with the company's stock price, to encourage, performance people to do what they can to help the company be successful. And for years, we've seen this trend where you're seeing less and less stock options and more restricted stock. And it comes with very different tax rules and strategies that people should be aware of if that's a portion of their compensation.
Yeah, absolutely. Let's dive right into that. You bring it up as far as a part of their compensation. How is that done? I mean, are you W-2'd as it? Is it seen as a part of your income from that company in addition to? How do they calculate that?
Yeah, so typically what happens is many companies on an annual basis, they award restricted stock to employees, right? And usually it's part of kind of the employee review process, and their manager, has so much stock to allot, and will decide who gets what. And so when those RSUs are originally granted, it's really there's no tax implications or anything, and they really don't have any value at that point. It's just kind of an accounting thing. And then what happens is those options or those shares will vest over time, typically on a vesting schedule. So it might be, if someone's awarded 100 shares, that 20 shares will vest after the first year, and then another 20 after the second year, and so on. So really, they're earning this stock over a 5-year time period. And as I said, these different grants can be given annually. So sometimes you'll have multiple grants that are vesting, right? So in 1 year, you'll have, 20 shares from your original grant, and then maybe 15 shares from, the grant the year later. So it can start to really add up over time as you have multiple grants vesting all within a given year. And so the way it works is, those restricted stock, partly the name, they're restricted, meaning you don't own them, you can't sell them, you can't really do anything with them until they vest. Then once they vest, at that point, that's taxable income, right? So whatever the value is of those shares when they vest is treated as compensation. It's very much like a bonus, except it's in the form of stock. And then that's where it can get tricky, because in essence, if that's a bonus, a bonus is going to have tax withholding, right? And maybe even Social Security, Medicare taxes, as well as federal and state income tax. And because you're actually getting these shares, there's not the cash there to pay those taxes. So there's a couple of options. And again, this is one of the one of the things that makes it interesting is, one, the employee can actually write a check to the company to cover the tax withholding.
Mm.
That way they get to keep all of the shares, but they still cover the required tax withholding on the, quote unquote bonus of these shares that they receive. The more common thing is that you set it up where you basically sell to cover, where they sell enough shares to be able to cover the taxes, right? So if you get 100 shares and they need to have a 35% or something withheld or sold to cover the taxes, they'd sell those 35 shares immediately. Those proceeds would go to cover the taxes, and the employee would be left with 65 shares that they now own. They've paid the taxes on them. And then if the shares go up, right, any gain after that, of course, would be subject to capital gains tax if sold, or if they go down, they could have a capital loss if they were to sell them after they've dipped in value.
Now, is the individual that is receiving RSUs, do they get to make that decision closer to tax time, or do they have to decide ahead of hand? And what I mean by that, to clarify, is as far as to sell some shares to cover the cost, or hold on to them because it will generate a loss, essentially.
Yeah, the initial, they have to make an election before the shares vest, right, as to how they're going to cover the taxes. But then they have between that vesting point and the end of the year to determine if they want to sell those shares, maybe because they're at a loss, or if they want to continue to hold them for the long term, which obviously is a whole nother consideration, because if you have an employee that's getting a lot of these RSU grants, very quickly, the company stock can become a big portion of their overall net worth, which is risky, right? To have both your income and a big portion of your wealth tied to one company. So there's also important considerations around long-term investment strategy, diversification, et cetera.
Okay, thank you. What about in situations if publicly held and privately held? Is there different circumstances, or are they pretty similar for how an employee might want to handle the situation?
Yeah, so privately held companies can be really tricky, right? When there's a public market, those shares can be freely sold when they vest to cover the taxes. With the private companies, there may not be a market. Right. So you can end up with, what we often refer to as a double trigger event. You have when the RSUs vest, obviously that's a taxable event where there may not be the liquidity to cover the taxes. So the employee may need to cover the taxes, write a check to cover the taxes. And then if things work out and the company eventually has an IPO, where an initial public offering where they now go public, that could create a whole nother potential taxable event. Or in some cases, you can have where the shares vest, but because there's no public market, that doesn't create a taxable event until the IPO. So it's really understanding how they're structured, and what the tax implications may be for private companies, which can be a lot more complex.
Yeah, and I'm guessing there isn't a situation when it's a privately held company to sell those shares back essentially to the company.
In some cases, yeah, in some cases, but obviously, you have a pre-IPO company, a private company, they may not have the cash flow to be buying back those shares and putting out the cash, right? They might actually be in a situation where they're raising cash from outside investors to try and keep the operations going. So it may not be an option. So that's where it can get tricky. But there's other mechanisms that can be used as well. There's what's called an 83I election, which is a bit complicated. Don't just go off of this podcast. Talk to a professional. But it's basically a way where the tax recognition can be accelerated. When the RSUs don't have a lot of value because it's early days in the company's life, and so you're able to accelerate the tax, which might seem odd. Why would you want to do that? But if you think it's at a lower price than where those RSUs will eventually vest as the company continues to grow and improve, it might make sense to do that 83I election and recognize a much smaller tax burden, own those shares even from a tax standpoint, it's treated as if you own them even before they vest. And then, it makes it a little easier to be able to ride it out until that eventual initial public offering when there's a market to be able to sell the shares.
Yeah. Well, I mean, in summary, what are we wanting? I mean, we're letting people know and giving them some insight, but at the end of the day, when it comes to these types of investments, like you said, there with the 83I, I mean, there's complex things here, so it's really good to take a look at your long-term plan and definitely, as you mentioned, even your diversification of being potentially locked into so much income coming from just one source.
Exactly. Yeah. The taxes are complicated. The different strategies are complicated. Obviously you're making a decision at a point in time without knowing what the future will hold. So you have to, balance, the short term versus the long term and what makes the most sense from a tax risk standpoint. And then, as you said, the diversification part, is often a constant challenge, especially if the company is doing really well. It's a good problem to have because it means those shares are becoming more and more valuable, but it also means they're becoming a bigger and bigger percentage of the individual's net worth. And then the other thing that, can be a real challenge that I know we've touched on in the past is the tax withholding in terms of when RSUs vest, the mandatory tax withholding. So typically when those RSUs vest, it's a set tax withholding percentage. And that's 22% federal. If you're in California, it's 10% state. And that can create a challenge because in many cases, 22% federal tax withholding is lower than the individual's tax bracket.
Right.
And so they're actually not having enough, they think, oh, they deducted the taxes, I'm covered. But if you have a significant amount in RSUs that vest and it's only 22% and you're in the 35% tax bracket, you're going to come up quite a bit short.
Right.
Typically, the state withholding is more or is closer to being in line with the actual tax that's owed. The exception there is if the total value of the RSUs that vest is $1 million or more, then they withhold at the maximum 35% tax rate. And so that that will typically cover the taxes, but it's pretty rare that you see that much vest in a given year.
Yeah. Well, definitely all those things to watch out for. And one way or another, it sounds like kind of a good situation to be in.
Yeah, it is. It is. And it's a great way to build value, but you really have to plan, especially if you're looking at leaving the company, right? Because if you have an unvested portion of stock, you really want to know what those company specific policies are. If you'll lose those RSUs, if they can be bought out at a certain rate, if you have a certain time period in which they may still vest, even though, you've terminated employment. So, yeah, I mean, at each and every stage of the journey, there's important considerations.
Yeah. All right. Well, let's jump into housing affordability. I mean, it continues to be a hot button as we see higher home prices. We still obviously have, our different stuff going on, property taxes and interest rates, etc. But are we seeing any more affordability coming to the housing market? Is there more building going on? What overall is the scope?
Yeah, there does seem to be a pickup in building and supply and whatnot, but it's just has not been enough to offset the affordability challenges, right? I mean, we've had, housing prices went up a lot during the pandemic. Then interest rates went up, which, makes it even more difficult to afford a house because values really didn't fall in any significant way. And now, if anything, maybe are ticking up again. And with higher interest rates, and as you said, the higher values comes with higher property taxes. And of course, in a lot of places, insurance costs are becoming a real challenge as insurance companies are leaving some markets. So what we're seeing is just an extreme problem with the lack of affordability. And what's interesting is we're seeing a lot of it in California, which, is no surprise based on historical norms. It was San Jose, California is the most unaffordable, where the household income needed to afford a home increased from $263,000 in 2020 to $454,000 here 4 years later.
Wow.
So, huge percentage increase. And obviously that's a, really high number compared to the median income.
Yeah.
And then you go down the list and you see it was followed closely by San Francisco, Los Angeles, and San Diego. So a number of the big metropolitan areas in California where we've seen a significant increase in the amount of household income needed to be able to afford the median home.
Yeah. Well, and that seems to indicate to me too, the more heavily populated areas, obviously, being if there's jobs there and that kind of competition of not only jobs, but then follows the housing market and so on.
Yeah, and these are higher income areas. So, obviously, as people are earning those incomes, they're going to compete for a limited housing stock and, bid up those values to, reflect their buying power. All of those California metro areas that we mentioned are pretty high income, and several others that are on the list. We've got Seattle, New York, and Boston. Right. And all of those houses and all of those metro areas, it's estimated you need household income in excess of 200,000 to be able to afford a house. And all of those are, known as high income, but also high cost of living areas.
Yeah. Yeah. Well, what about taking a look here at home? Obviously, we mentioned, the Bay Area, which I think people expect: San Jose, San Francisco, and Los Angeles, of course, and San Diego, big beach community, so to speak. But what about our state capital? I mean, it doesn't seem to make the news with this, but, every time I've gone up there to visit you folks at Plan Solutions and take a look around it, I'm seeing that there is an increase for sure.
Yeah, Sacramento has been a tough market. In fact, it ranks 10th for the most unaffordable metro area. I think partly the spillover from, the Bay Area. There we saw the household income required to buy a home increase 68% from 2020 to 2024. So that was an increase from 102,000 to 172,000. So, wow. A big increase. And unfortunately, there's not a lot of signs that things are going to get better on the affordability. I mean, mortgage rates remain stubbornly high. There's still, arguably a lack of supply compared to the level of demand, which is supporting home prices, and, a number of other factors that just cause home prices to remain relatively high and the market undersupplied. That's just making it more and more difficult for households to be able to generate the income needed to afford to buy.
Yeah, yeah, absolutely. Well, I know I was talking with a local contractor here in my area, and I know it probably, for the Bay Area stuff and maybe even Sacramento, I'm not sure, but even getting those permits, it's a heck of a process. So, there's lots of things that kind of hold up, but, it's due process and it takes some time.
Yeah, local land use does have a lot to do with with affordability. Permitting and all of the different rules related to that. Of course, increased standards in the case of energy efficiency and requiring solar and things like that. I mean, these are all just add to those costs, right? So the cost of building is higher. So the price that they have to demand or be able to get to cover those added building costs has to be higher before it makes sense for builders to move in and increase supply.
Yeah. Yeah. All right. Well, let's jump to converting savings bonds to electronic bonds. We were just talking about bonds in the prior podcast recording. So this was really interesting that I wasn't aware of this. So I'm glad you put this out there. But it seems that owners of paper U.S. savings bonds can convert to electronic form.
Yeah, we talked about it recently, making sure to keep track of those paper savings bonds, not lose them. They end up maturing and people haven't cashed them in and you're not earning any money. I mean, all of those challenges. And so this was a question that came up and we thought, it's worth maybe going a little deeper down this rabbit hole. Because as we discussed before, if you have these paper bonds, you can go and enter the serial numbers on the Treasury Direct website and get all of that information to be able to manage them. And some people are saying, well, I have these old paper bonds, but really I'd rather, them be held electronically like the new bonds that are issued. So I can just use this website to manage them like we do with a lot of other things. And there is a way that you can go and you can convert those paper bonds to electronic bonds. with the U.S. Treasury. So it can be, safer, more convenient way of holding the bonds and managing and tracking them. And you're able to do this without really changing the characteristics of the bond. Everything will stay the same. It's not a taxable event, right? It's not cashing in the bond. It's just setting it up on their website so that you have that online access and, quicker ability to really see, okay, how much accrued interest is here? What are they worth? What interest rate are they paying? And then be able to manage them a bit more efficiently.
And what do they do when a bonds finally mature? Is that all done electronically, the cash out, so to speak?
That's right. Yeah. So once the bond matures, they'll, automatically pay it to your account. You can use it to buy more bonds. You can take the money out. At that point, that will be a taxable event. But at least you're not forgetting about a bond that's matured and not earning any interest, that's sitting in a drawer somewhere. So at least it's, it's creating this automatic reminder and way to get access to the money.
Yeah. And that's funny. I'm just having a flashback of around when you and I went off to college and forgetting I had a drawer full of bonds that grandparents and aunts and uncles had bought, and it's like, oh my goodness, I got some money sitting here. So that's good that they're moving forward technology wise. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. Got 2 items pinned up there. What do we got first, Mr. Armour?
Yeah, one is Daryl recently went to the Financial Planning Association's NorCal conference, which is one of the big ones nationwide. It's held in San Francisco every year. Always gets really high ratings, and Daryl's been very active in the local Financial Planning Association, so he obviously wanted to support their efforts to promote the regional conference. And he came back and brought a lot of notes and things of what seemed like a program with some really interesting speakers. You had industry experts, investment company CEOs, experts on company culture, and just a variety of financial planning topics. Although I think the real draw for those in-person type conferences, which not necessarily as popular post pandemic, as we just got so used to doing things online, but just a great opportunity to network with other planners, right? And keep up with interesting industry trends and discuss best practices and what are ways that, people can share how they're helping their clients and being proactive and then you can learn from that.
Absolutely. What's the second item we got pinned up there?
Well, it's graduation season. I'm sure a lot of people have been spending times in, high school gyms or out in the sun on the football field watching, friends and family graduate, and that's great. I mean, congratulations to all the high school and college graduates, and of course, that really intersects with financial planning, right? Navigating the college funding landscape, or from going from college to the workforce, and navigating the employee benefits landscape. All important places where a knowledgeable financial planner can be a really good resource. So, I want to just basically reach out and say, congratulations to those who graduated, or to the friends and family that helped them get there. But also, if you need help dealing with kind of some of the financial implications of these next stage, that's what we're here for.
Absolutely. Anything else you want to add, Mr. Armour, before we wrap up this episode?
No, just, we're here kind of in the doldrums of summer for the financial markets. There's the old saying, sell in May and go away. Typically the market's pretty flat over the summer, although, things have been pretty good so far. So hopefully that continues.
Absolutely. Well, we thank you all for listening to the podcast, of course, available on Apple Podcasts, Spotify, and now on YouTube, where you can go and the Personal Financial Review. You follow along as you're listening to a video of it, and you'll see the content we discuss here. But of course, if you want to subscribe to the Personal Financial Review, all you got to do is send Katie an email at Plan Solutions, KATIE at plansolutions.com, and get subscribed to the Personal Financial Review. And we thank you for listening.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.